and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Tensions have eased, and investors took their, got a little less emotional and a little less worried. So I think that same thing could easily happen again. Yes, investors are walking on eggshells right now in terms of worrying about oil prices, but I think once we see some kind of de-escalation in tensions, that will likely dissipate.
When we look at the amount of money that hurricanes have caused from 1980 through 2023, damages were upwards of $2.6 trillion. That's roughly $60 billion a year. So imagine as a share of GDP, that's like 0.2%, but it could potentially cut anywhere from up to 0.3 off of GDP after the event. However, a lot of that can potentially be offset by rebuilding, but nonetheless, it's highly disruptive. And when we look at the storms that have been coming through, they've been impacting large swaths of the labor market.
The revenues went up from 2.8 billion to 3.5 billion from 22 to 23, and they're going up again to 4.2 billion this year. So do I really care as an investor if the user count has been consistently inflated? I don't.
We got 1 hour to go until the market close, and we're taking a look at the major averages here. We do have stocks coming back today, although the Dow's been bouncing between gains and losses. Right now to the green, up 129 points, about a third of 1%. The S&P 500 up 0.9 of 1%. The Nasdaq is leading here, up 1.3%. We've got some strength happening in tech today. Tech coming back.
Yeah, Nvidia coming back. That's a focus. And of course, it's right before we head into earnings season. Julie, big tech is on deck, and some of those same questions talking about AI will be about AI monetization will be front and center.
Yes, definitely. So Nvidia's been on a little tear here. If you take a look at a little more detail, today it's up about 4%. And I'm watching once again that we're getting maybe back close to some of the record levels. Now, the stock closed at a record back in June 18th to be specific. 135.58 is what we're looking at. So we're getting up there, getting back up towards those levels. We'll see if we re-achieve it. But it's not just Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta. You know, it's interesting. We're going to have a discussion later in the show today about how the Magnificent Seven has been sort of lagging as of late. But today
in the green.
That is not the case. Looking elsewhere at some of the things we're watching oil prices. Continue to watch them here today. It's been an interesting trajectory because we saw oil fall today on perhaps some disappointing lack of stimulus announcements out of China, and people continue to watch the headlines out of the Mideast.
Yeah, it seems like at least today, Chinese authorities disappointed, right? No new stimulus, and that, at least in today's trade, seems to kind of be overriding, Julie, this, fears of spreading war overseas in the Middle East. Although there was also that NBC News report that Israel is still considering a range of options, including possibly hitting Iran's energy facilities, so still front and center. Yeah,
and Prime Minister of Israel, Benjamin Netanyahu, saying that they had struck and killed the replacement for the Hezbollah leader who they had recently killed. We did see oil come off of the lows a little bit on that, but still off 4% on the day. And finally, quick check on what's going on in the Treasury market. That's because we got some Fed speak today. Nothing really huge there. Raphael Bostic, as one example, said the bank is trying to balance the risks here as it tries to weigh what to do.
Lots of Fed speak, so as usual, everybody's kind of trying to parsing that, looking for clues, right, what could come next. All kinds of speakers. We had St. Louis president, for example, seemed to be suggesting, we'd support more cuts, but also just suggesting the Fed should be cautious. Patience was a word that was invoked, so.
We don't know what's going to happen.
Maybe our guest does.
Hopefully.
Yes. For more on the latest market moves, let's now welcome in our first guest today. That is David Sekera, Morningstar Chief U.S. Market Strategist. David, it is good to see you as always. I was thinking, David, we last saw you, I believe it was early September. It was before the Fed meeting, David. And you came on the show and you said, listen, I'd be very concerned if the Fed did 50, but they did deliver, David, that supersized cut. So what do you make of that move, and what do you think the Fed's next move is?
Well, we're looking for 2 more 25 basis point cuts from the Fed at the next 2 meetings. Yeah, we still think inflation is going to be on a downward path, not only for the rest of this year, but going into next year as well. our U.S. economics team actually expects inflation to run below the Fed's target next year. But we do expect that the economy is slowing here in the fourth quarter and probably won't bottom out until the second quarter of next year, and then it'll reaccelerate in the second half of next year. So we actually are looking for the Fed to continue cutting next year, looking for the Fed to get to that 3 to 3.25% range. So essentially at the end of the day, that 50 basis point cut, while it was a surprise, in my mind, really just pulls forward one of the cuts that we would have been expecting next year.
Gotcha, David. So it doesn't sound like you're that concerned then that the labor report we just got is going to sort of reignite inflation, or at least your economics team doesn't think so, and that's informing how you're thinking about the stock market.
Exactly. Although some of the moves that I've seen in the 10-year have been a little concerning, with the 10-year getting back above 4%. So since that 50 basis point cut, we have seen a pretty big move in the Treasury market. I think we've backed up about 35 to 40 basis points on that 10-year. Now, I'm not concerned about the 10-year really impacting the equity markets until maybe it got up to that 4.5% area. If we started getting to 4.5% or higher at that point, I would start to get concerned about some of the large cap growth tech names, maybe being under pressure if rates were continuing to rise.
And David, I want to switch gears to another big theme. I was just talking to Julie there at the top. Geopolitical tensions are front and center. How, as a strategist, are you thinking through that dynamic?
Yeah, I think we're just watching it day by day, waiting to see what, if any, escalation comes out. If there is additional escalation, of course, it'll depend on exactly what it is, whether or not they try going after some of the oil assets in Iran. So again, it's really, you just got to watch it day by day. But for now, with earnings season coming up, taking a look at some of the economic indicators that are coming out, I think the market right now really is focused on really the fundamentals, the economy, and then earnings.
Let's talk about groups, David, because the last time we spoke to you, you said you liked utilities, that even though they had already had a run the year, you thought they could keep going. Well, they did keep going, but now you say maybe they're not going to keep going at this point. So talk to me about utilities and what people should be doing with them.
Yeah, I mean, it was actually a year ago that we really started pounding the table on the utility sector. Of course, I had sold off as interest rates were going up last year. And it bottomed out October of last year. We noted that the utility sector is really at some of its lowest valuations that we've seen over the past decade. Since October of last year, I think utilities up are over 40%. I think they're up 30% year to date. So again, while we still see a lot of good fundamentals in the utility sector, growing demand for electricity as AI becomes more rampant out there. Again, it's just a matter of valuation at this point, that the utility sector overall is overvalued. Now is a great time to either take some profit off the table or at least swap out of some of those names that have moved up the most and move into some of those names that are at least still maybe undervalued, or if not, at least fairly valued.
So let's talk about what you like, David. You do like small caps. You'd recommend overweighting those pint-sized companies. How come, David? Just walk us through the reasoning. And are there specific verticals you'd recommend within small caps?
So within the small caps, I like it really both from an absolute valuation basis as well as a market relative valuation basis. So when we look at the small cap sector overall, it trades at about a 15% discount to a composite of our fair values. But then when I also compare it to our price to fair value metrics for the overall market, while it's gotten a good bounce the past couple months as we've seen the rotation in the small caps, it's still at some of the lowest levels that we've seen over the past decade. We also actually like the value category as well. That trades at about a 3% discount to fair value, so a better relative value than the market, which actually trades at about a 3% premium to fair value today. So really, if you want to get into verticals, if you cross those two and you go into small cap and value, that's definitely going to be where we see the most undervalued opportunities today.
And do you think that rotation is going to accelerate, David? Because a lot of people have talked a lot about small caps this year benefiting from rate cuts, and that hasn't really fully come to fruition.
I think we're starting to see that come to fruition now. So I think in July is really when I noted kind of the first big market rotation going into small caps, down in capitalization, as well into value stocks. And a lot of that just became, because a lot of the AI stocks, the large cap, the growth names, most levered to AI, we're getting to the territory where they're at least fully valued, if not getting to be overvalued according to our valuations, where of course value stocks have been left behind and small cap stocks left behind. We do think that that rotation still has further to go. And again, it's just a combination of being cheap on an absolute value basis as well as relative value basis.
Finally, David, I want to talk about election risk here and whether you think we can use history as a guide, because this election does appear kind of different. I mean, if you believe the polls, it is basically a toss-up. Can we use history as a guide, or are we in a new territory here in terms of how we should approach it as investors?
I think you have to be really careful trying to use history as a guide, surrounding the presidential elections. Yeah, we've done a lot of analysis on it, and what we found is, depending on what time frames you use, you can really come up with a case, for either party being, better or worse for the market, better or worse for the economy. And at the end of the day, it's really going to be a lot of exogenous variables out there, both globally as well as in the markets, and where the markets are valued going into the election. That's really going to dictate how the market performs thereafter. So personally, as a long-term investor, I tried not to look at and trade the market based on those kind of short-term variables, because again, it really is going to depend on how those play out over time.
David, great to see you. Thanks for joining us.
Well, thank you.
Let's check in on one of our top stories of the day. Shares of Roblox sinking after short seller Hindenburg Research alleged that the gaming platform's metrics are inflated, and also expressed concerns regarding Roblox's inability to generate a profit. Also, the Hindenburg report talking about what it says is sort of sexual predators being on the platform. That's something that's been reported on. It's also something that Roblox has said that it has tried to fight against. And speaking of what Roblox has said, they said in a statement to Yahoo Finance, "We totally reject the claims made in the report." They said the financial claims are misleading, and basically pointed out the bookings that the company has generated. That's their amount of cash receipts is up over 22% over the past 4 quarters to $955 million in the second quarter.
Yeah, it isn't just Hindenburg, though, as well. I mean, the Bear Cave, which is a newsletter catering to short sellers, they've been on this, publishing reports. I saw Bloomberg analyst Julie those analysts were kind of weighing in on this, saying it's partnerships, they said, with big brands. They mentioned Walmart, they mentioned Nike, alleviate our concerns about brand safety, but it may still need, they said, to invest in parent controls and cleaning up bots. So
yeah, I mean, the shares are down this year about 12%. They're falling today, but not by a huge amount, right? And there are defenders out there. One of them is Michael Pachter, who we talked to earlier of Wedbush, and he said yes, there are concerns about people on the platform who have ill intent, but he also talked about the company's financial metrics. Here's what he said.
The revenues went up from 2.8 billion to 3.5 billion from 22 to 23, and they're going up again to 4.2 billion this year. So do I really care as an investor if the user count has been consistently inflated? I don't.
And a little anecdotal thing about Roblox, which I always like to do because my kids play it, my younger one in particular, and he uses something called away from keyboard training, AFK training. And basically what he does is he has a bot, or he puts it on auto to try and get points or clicks. And obviously I don't know as much about this as I could. But this is one of the things that the Hindenburg report pointed to as evidence that there is not as much engagement on the platform. Now, I would say, regardless of his AFK training, he is pretty darn engaged.
He's putting hours. We got to bring him on as sort of third party.
We got to bring him back.
Third party research.
Let's do it. All right, we're just getting started here on Market Domination. Coming up, PepsiCo announcing third quarter earnings this morning. We're going to break down the latest with the company's Citi's vice president of U.S. beverages on the other side. Plus, with oil prices slipping today, how should investors be thinking about energy stocks? We're going to discuss later in the hour. And Nvidia shares jumping on the back of strong chip demand. We'll take a deeper dive into the best ways to be positioned among the Magnificent 7 tech stocks with today's investor playbook. Stay tuned, much more Market Domination still to come. Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Checking in on some U.S.-listed China tech stocks that are in trouble today as investors show some concerns over China's stimulus. Alibaba, JD.com, PDD, they're all sinking along with some of the U.S. companies that have exposure in China, the casinos in particular, we've been keeping an eye on as well. Now, as we know, we've been talking a lot about China's stimulus lately. And the People's Bank of China, as well as the authorities there, have recently announced some various measures. However, today, the country's economic planning agency they just started coming off their Golden Week holiday. They had a briefing today, and what they announced is that spending of about $28 billion is going to happen next year. But that's a lot smaller than a lot of people.
Underwhelming.
Yes, the so-called stimulus bazooka that people were looking for, that ain't it. And so that's why we're seeing some disappointment today.
Yeah, this one's been an interesting battleground because there were some strategists, Julie, and we had them on air, who were making the case that they would say, listen, I really don't know whether what's been announced, how exactly it's going to ripple through the economy and the markets over there. But they were buying because they just said everything is so beat up already that it was a value play.
Right. Well, I mean, the action in the Chinese markets has been bonkers because, again, things were closed because of the Golden Week holiday. You could trade in Hong Kong, but not onshore. In China, we saw the Shanghai Composite shoot up, then come down sharply after this briefing. The Hang Seng the Hang Seng having its worst day since 2008.
Yeah.
So it's an extremely high trading volume as well. So we're going to have to continue to keep an eye on what's going on.
All right, we will. Moving on, shares of Robinhood, they are soaring higher today after the company announced it would hold its first investor day December 4th, where the company plans to lay out its vision for the next decade. So highest intraday level, by the way, since December 2021. Did announce plans, first investor day, December 4th, here in New York. We'll share more about its vision going forward. The move in this name is incredible. I mean, it's up now about 100% now so far this year, Julie.
It is up 100% this year. The volume today is unusually high as well. It's about 3 times what it was just yesterday. We're seeing options volume also tick up. It has done very well this year. However, the stock came public back in 2021 at $38, and you can see it's trading more than $10 below that. So it's come back a lot, and it has had a great year, and a lot of investors are paying attention. But it's still, a lot of companies came public in 2021, did amazing then, and then have come down sharply. And this is one that has not regained those levels.
We spoke to Devin Ryan, Citizens JMP analyst, very smart guy, still banging the table on this one.
Yes, he is. By the way, another company that did very, very well in 2021, although that's not when it came public, is DocuSign. Those shares are higher today. The software company is going to become the newest member of the S&P Mid-Cap 400 Index. It will replace MDU Resources Group as of the market open on October 11th here. And DocuSign up about 7% right now. This stock peaked at $310 in 2021 when, some people said, we're never going back to pen and paper. We're just going to sign every document here and forever for the rest of time, which even if that were true, DocuSign, as analysts have said, is sort of needs to expand its services, which it has been working on doing under new leadership.
Yeah, this one's interesting. I mean, most on the street are on the sidelines. Bulls, they'll talk about valuation, multiple potential growth drivers. Some on the street also think this name, private equity potential takeout target. It's another thing.
We've been seeing a lot of that lately.
You have. All right, PepsiCo is moving higher today, despite the company revealing a Q3 miss on revenue and earnings this morning before the bell. Joining us now to help us break down PepsiCo's quarter is Citi U.S. Beverages, Household Products, and Personal Care lead analyst Filippo Falorni. Filippo, it is good to see you. So PepsiCo reports, stocks popping here about 2%. Walk us through the report. What did you make of it?
Hey, Josh. Thanks for having me on. Look, the quarter was a bit softer than expected. Their organic sales metric, which is a widely looked metric in consumer staples, was up 1.3%. Expectations were more in the 3% range. So a bit of a softer quarter. The weakness was really in the North America business, both in the snacking and the Quaker food business. And then a little bit of softening in some international markets like China, Middle East, even Latin America. Also, Pepsi lowered their full year guidance on organic sales. They were previously expecting approximately 4%. They're now expecting a low single digit, more in the 2% range. But despite that, they also reiterated their EPS guidance. So they talked about increased productivity. So there's not really a lot of risk to the bottom line. And that, I think, given the sentiment was already pretty negative into the print, that's what drove the positive reaction today.
Hey, Filippo, I'm curious what this tells us about how the rest of the sector might do, right? Both beverages, but also snacking. If they're sort of seeing weak top line here, what does that tell us about competitors?
Yes, Julie, that's a really good question. I mean, look, clearly the consumer is feeling more depression after really 3 years of very high inflation in consumer product goods. And now you're starting to see, especially the low-income consumer, really have more value-seeking behaviors. So one theme that we've seen throughout last earnings season, and I think is going to be very evident in the Q3 earnings season, is that many of these companies are going to talk about more promotional activity, so giving back value to the consumer. Clearly, CPI has cooled off. Now, a lot of the focus, both from retailers, but also more government pressure to lower consumer prices of many of these products. So I think most of these companies, what they're talking about, the first step is going to be increased promotional activity, focus more on giving value with larger pack sizes, and ultimately, in some cases, you might have to see some price reduction for certain categories.
Filippo, I'm just curious, if you're an investor in names like this, not near term, but longer term, how concerned, if at all, should you be about GLP-1s and their impact on just names like this, but also throughout your coverage universe?
Yeah, look, that's been a focus for investors, especially last year. There was a lot of focus as many of these drugs were starting to take traction. It obviously comes up in a lot of investor conversations. We've done a deep dive analysis of GLP-1 and the potential impact. And really, when you think about the penetration in terms of use of these drugs across the US, it's still pretty limited. And even combining some pretty rosy forecasts of the increasing penetration over the next 5 years, the impact on volumes, we're talking about less than a point, more like in the 0.5 to 0.6%. So really, there is a little bit of impact, but I think the main reason of the weakness that you're seeing in volumes for many categories, including salty snacks, is more the amount of pricing that was taken over the last 3 years, and a need to reset prices with promotions or with value packs back to the consumer to really re-stimulate demand in many categories.
And speaking about pricing, I'm also curious about the sort of pricing to sizing ratios here. In other words, what people call shrinkflation. Are we seeing Pepsi and competitors do that, and how do the economics look for them on that front?
Yeah, that is a very important topic. I know there's a lot more political attention to shrinkflation. I know Congress is clearly making it a focus to push back on these companies to give value back to the consumer. And Pepsi talked about it today on the earnings call. So historically, many of these companies have used smaller pack size as a way of driving positive mix. So instead of selling you a large pack of chips, I'm selling you a smaller pack. And the price per individual chip, price per unit, is actually a lot higher on the smaller packs. So you get better price mix realization. But now a lot of the focus, both from the government, both from retailers, as well as the companies, is now to give back value to consumers. So Pepsi today talked about giving more value in the form of larger pack, or, for example, bigger multi-packs with more smaller pack within the multi-pack, as a way of, again, giving back value to the consumer after significant price increases over the last 3 years.
And Filippo, I'm curious, how is geopolitical tensions, how is that impacting Pepsi and kind of rippling through the other names you cover?
Yeah, look, geopolitical tensions are clearly rising around the world. The Middle East has been a pressure point for many companies. There's anti-American brand sentiment in many countries in the Middle East. Pepsi talked about it today on the earnings call. Coca-Cola has had about a 1 point volume impact, negative impact from the Middle East over the last couple of quarters. Procter & Gamble talked about it as well for brands very recognizable like Pampers. So there's clearly some pressure for multinational companies in the region. China also remains a little bit of a pressure point. The environment is pretty soft. There's a lot of hope for the stimulus, but as you guys talked about, the numbers there are a little bit lower than expected, and so this is probably going to take a little bit longer to improve. So there are pockets of the world where really the consumer is softer, and there's a little bit of anti-American brand sentiment that is impacting these multinational companies.
Filippo, great to have you on the show today. Thanks so much for joining us.
Thanks for having me.
And coming up, oil prices slipping below $80 a barrel today. So how should investors be thinking about oil and energy stocks? We'll discuss on the other side when market domination returns.
We've been following the energy sector as crude prices have jumped recently amid rising tensions in the Mideast. ExxonMobil shares trading near an all-time high. So how should investors be thinking about energy stocks? For more, we're bringing in Neil Dingman, Managing Director at Truist Securities. And Neil, of course, today oil is down because we're getting what people are seeing as disappointing news, or lack of news, I guess, out of China. So first, I guess, talk to us about oil prices versus the oil stocks themselves, and what kind of correlation that we're seeing.
Sure. Thanks for having me. I think what we're seeing, and you mentioned even Exxon, not only I think in energy, but in the overall sector, we're seeing a bit more risk off these days. I'm just surprised. I've been out a lot talking to many investors, and I just find it quite surprising how consensus, I would even call it bearish energy investors are on oil, yet they still remain quite bullish on gas. So to me, when you have days like today, the risk off, as you mentioned, I think not only from China, but just less geopolitical tension going on out there, or perceived less geopolitical tension. It's not surprised to see some of the more volatile names getting hit harder, and then the Exxons and some of the other higher quality names holding in better.
I am, Neil, there was an NBC report that dropped reporting that Israeli officials still considering a range of options, and that could include hitting Iranian oil facilities. If that happened, Neil, and you talk, I'm sure your clients are asking about it, what would be the economic impact, the sentiment impact?
I mean, the impact, I think, would be very quick and quite severe. I think you're talking about immediate 10%, potentially even 15%. You think about, not only what Saudi accounts and the Middle East accounts for existing, but the amount of voluntary production that they continue to have offline, which could, add to that. So again, if all that supply starts to come off very, very quickly, I think what investors realize is the U.S. is not going to be able to make that up in a short amount of period, and thus, as such, I think you have prices go up very quickly.
And is that potential upside risk a reason to hold the oil majors right now, Neil?
I think that, but I think more so, I just think the amount of supply is going to be limited out there. Even if demand is not as high as maybe hoped, I still think it's going to be stable. So to me, the reason to hold the group is it's hard to find a sector where you see better shareholder return in the form of both dividends and buybacks than you do most of the energy stocks these days. So again, I probably find myself maybe a little more cautiously optimistic, finding more higher quality names, but yet a lot of these names are names that can, if you add both the share, both dividends and the stock buybacks, you're talking about upwards to 10% is what they're paying out.
So Neil, as you screen for those higher quality names, Diamondback Energy, is that another name that would fit the bill?
Absolutely. That's my favorite. I mean, and what's the key behind their success? They're the lowest operator. You mentioned Exxon. I mean, Diamondback's they're pure Permian based out of Midland, Texas. Their break even is in the mid-30s. So again, yes, they would love for prices to be higher like every other energy company. But even if prices come down once again to the mid-60s, Diamondback is generating a ton of free cash flow. And I think you'll see them continue to pay a very strong dividend and continue to buy back a material amount of shares.
Now, one of the interesting things I picked up in one of your notes recently is you talk about that balance between that payout and having low leverage on the balance sheet, low debt, paying and maybe using some of that free cash flow to pay down that debt instead of shareholder returns. How are you thinking about what is more attractive in this environment?
It's a great point, Julie, because what's been interesting is 3 or 4 years ago, investors in my space, energy investors, were comfortable with at least 2 times, if not 3 times leverage. And now a number of investors get nervous with even 1 times leverage. So again, I think for most of my companies, I would prefer that they're at least under 1 times. But once they get under 1 times leverage, I would hope that they would lean more into shareholder return. But again, there's a number of smaller companies that currently today have around 1.5 or maybe a little bit more times leverage. I prefer that those companies focus primarily on debt repayment until they get closer to sub 1.
Neil, always great having you on the show. Thanks for joining us.
Thank you all.
All right, let's get to some calls of the day now. KeyBank Capital Markets downgrading Qualcomm from overweight to sector weight. The note saying that the company is being viewed less as an edge AI play than previously anticipated. So this is John Vinn over at KeyBank, downgrades the chip maker to sector weight. Why the lack of love, Julie? I think the money quote here is they say our previous thesis was that the company would be increasingly viewed as an edge AI play given its positioning in handsets and PCs, but given that the end markets have yet to materialize in any meaningful manner, we don't foresee Qualcomm benefiting from a replacement cycle fundamentally or being given a market premium as an edge AI beneficiary until, he says, that happens.
I don't have an AI phone yet. I don't have an AI computer yet, to his
You're playing
point.
right into John's thesis.
Exactly. Something else he talked about that I thought was interesting is the competition from Apple, which is currently one of Qualcomm's biggest customers. Qualcomm makes the internal modems in Apple devices. John is saying that Apple's going to begin to ramp its internal modem in stages over the next several years. Qualcomm is trying to diversify its revenue away from Apple to build up other sources of revenue. He says they're doing that, but they might not be able to do it quickly enough to make up for that lost revenue that's going to come as Apple makes this change.
And speaking of competition, John also saying we believe that Qualcomm will start to lose market share to MediaTek in the mid to low end segment of the smartphone market, given increased price competition. Told his clients he thinks this will increasingly be a headwind for Qualcomm in the first half of next year.
We will be watching that. Also, BTIG, they are active today. Analysts, they're upgrading Affirm from neutral to buy and cutting American Express to sell from neutral. The note citing Affirm's path to profitability and that the company can beat American Express's operating income margin. A sell always catches our attention because they are pretty rare here. And the analyst over there at PTIG says, quote, American Express fundamentals are more likely to get worse than better, yet expectations for rapid improvement continue to climb. The price target there for Amex set at $230.
Yeah, and meanwhile, they like Affirm. Stock is down about 20% this year, but they clearly think that's a good time to carve out a position. They talk about a path to profitability for Max Levchin's company. They're on a GAAP basis. They think they can beat Amex on operating income margins. Say it's taking share from traditional forms of consumer point-of-sale finance. So lots of love for Max.
Yes.
All right, moving on. BNP Paribas initiating coverage on Palo Alto Networks with an outperform price target for 10. The note highlighting tailwinds to growth, including, you guessed it, AI, Julie. Nice pop there. Look at that, about 5%. So they initiate coverage actually of 8 companies that they say represent some of the best ways to place software that they told their clients are less sensitive to the macro, are mission critical and have significant secular tailwinds to growth, including AI. They like Palo Alto, give that one an outperform, also like Datadog and Viva Systems.
Yes, and first of all, they really make clear the threat that they believe is still faced, and then that's why these cybersecurity companies are so vital. Also, the analysts, led by Andrew DeGasperi, are saying, is Palo Alto the next Salesforce in cybersecurity, saying that this company is transitioning to become one of the largest pure-play cybersecurity software companies in the world. They say it's going to continue to gain market share, and growth is going to accelerate for
You know what they don't like?
Tell me.
Cloudflare.
Oh,
no
interesting.
love. It said given downside risk to estimates, initiate there with an underperform. So sell.
Interesting.
I love them. All right, coming up, shares of Nvidia jumping today. We're going to get you the latest details on why and tell you the best ways to be positioned among the Mag 7 tech stocks. Stick around, much more market domination. Still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Nvidia demonstrating its offerings beyond AI processors, the company providing greater insights into the company's various software platforms in its AI summit in Washington, D.C. For more on this, we have Yahoo Finance's Dan Howley. Dan.
Yeah, Josh, they basically did a lot of talking, kind of laying the background of NVIDIA, telling everybody there in D.C. for this summit. This is the first time they're holding this summit since 2019 in D.C. And so they wanted to kind of give the background of where NVIDIA came from and then really kind of point to the software offerings that they have and how well they're doing and how important they are to NVIDIA. And so, we talk so much about the hardware itself, the Blackwell chips, the different permutations of that and the Hopper chips and how demand is for both of those. But post-hardware explosion, NVIDIA seems to be setting itself up as a software company as well. So essentially saying, look, we're not just about chips. We know you all know us about
software,
us.
Networking, got it all.
Soup to nuts, networking as well. Yeah, and I think, that's obviously an important kind of thread to the NVIDIA story, because the more people that start to use its software, well, they're not going to want to leave, right? They're going to want to stick with NVIDIA going forward. So, I built my AI service on NVIDIA's platforms. Well, I'm not going to go to AMD now. I'm not going to go to Intel. I'm going to stick with NVIDIA. And now, I need to upgrade my chips. Probably just go with NVIDIA, right? I don't want to have to, kind of go back to the drawing board. And so it's an important strategy for NVIDIA now, pointing this out. And so, they talk about how they're working with Carnegie Mellon University and the University of Pittsburgh on different learning facilities for things like robotics and automation. They brought up how they're working with the likes of AT&T and Accenture, kind of going over how these different companies are using NVIDIA's own software to enhance their AI capabilities. And so you imagine that if they're building, like I said, these different pieces of software, these services, or even testing them at this point with NVIDIA's software, they're going to continue to go back to NVIDIA as well, just because it wouldn't make sense to kind of, restart from the beginning without them.
Yeah, a captive audience, I guess. And sticking with NVIDIA, the chipmaker is also teaming up with Foxconn on an AI supercomputer. So tell us more about that.
Yeah, they're not only teaming up with an AI supercomputer, they're teaming up with them for one of the largest factories for chips around that they've built. They're going to be opening this up in Mexico, and it's going to focus seemingly on NVIDIA's GB200 chips. And so this is a big deal for not just NVIDIA, not just Foxconn, but kind of the West, I guess, as you would think about it, the North America, the Americas, because there's so much chip building in Taiwan, in China, and there's not so much on this side of the world. And so this is a big win for Mexico primarily, but then for Foxconn to be able to get this factory built, and then for NVIDIA to be getting this kind of production capability up and running. It's going to take a while for this to get built. This isn't something that you're not building a Wendy's, right? It's much larger. Although if they were, and it was the largest, that's a lot of Frosties. But still, this is going to be something that's going to take quite a while for them to complete. But for Foxconn to be doing this, for NVIDIA to be doing this, huge deal for chip production on this side of the world.
Frosties. All right, Dan Howley, thank you very much. Appreciate it. Well, after a solid start to the year, the tech sector lagged in the third quarter. Even the Magnificent Seven are not safe from the sluggishness. So we have a look here. This is just the S&P 500 year to date. First of all, on a percentage basis, it's up about 20%. Of the Magnificent Seven, there are only two stocks that have done better than the S&P 500. This is as of sort of midday today. One of them is NVIDIA, up about 166%. So has not reattained the record high it reached back in June, but still has been mostly up and to the right. And the other is Meta, which also is trading near a record and is up about 66% this year. But the other five of the Magnificent Seven have underperformed, or at least sort of flirting with being even with the S&P 500. We've got Amazon up almost 20%, so almost matching the performance of the S&P 500. Alphabet and Apple both up around 17% or so. Microsoft up 10%. And then, of course, the laggard is Tesla, which is down about 1%. So all of the talk, all of the discussions we've been having about the Magnificent Seven, that they really buoyed the underlying index for so long, and now we are seeing a broadening. This is yet another way of showing that broadening, that diversification that we are seeing in the market here, not just between tech and everything else, but even amongst the Magnificent Seven itself. And another way of illustrating this is to point out what is the best performing stock in the S&P 500 this year, which isn't a Magnificent Seven stock. It's not a tech stock at all. It's Vistra. Remember that power company down today, but that stock is up 233% year to date. Of course, this also has to do with the AI story, because it has to do with the demand, the increasing power demands because of data center usage. So it's still an AI story, still a tech story, but it's not a tech stock. Josh?
Thank you, Julie. With most Magnificent Seven stocks underperforming the S&P 500 so far this year, and tech attempting a recovery from a lackluster third quarter, we're looking at how to navigate the big picture with the Yahoo Finance Playbook. T. Rowe Price portfolio manager Dominic Rizzo joining us now to discuss. Dominic, it is good to see you. So big tech earnings on deck. Different themes we'll be listing for, but one of them is surely going to be this theme, Dom, of AI monetization. It was a theme last earnings season. You heard, I think, some pushback from investors. Show me the money. Do you expect that to be another theme this earnings season, Dom?
Well, first off, thanks for having me. I do expect this to be another theme this earnings season, but when I look at the return on investment for the hyperscalers and for the entire technology sector, I actually think we're starting to see it. I mean, take Meta as an example. At one point during the year, people thought that Meta would have Q4 growth rates in the mid-single digits. Now that number is closer to 20%. And why is that? That's because they've been able to use AI to get a lot better targeting in their core advertising business. On Apple, I think we're going to see the beginning of an upgrade cycle that's going to last over the next 24 months. And then, of course, of the Mag 7, Nvidia is probably the best position for this whole thing, as they're selling the linchpin technology to all these vendors.
I mean, I guess it's worth asking the question, though, Dom, should we even think about the Mag? I mean, these things change, right? We had the FANGs, then we had the Mag 7. Like, do we need a different term? Should we even be lumping all these guys together at this point?
Well, like you said on the segment before, it's really been the Magnificent Two this year, and they all have really different business models, right? You know, some of them are much more internet focused, and obviously Nvidia is more hardware and software focused. But I think the divergence that we've seen amongst the Magnificent Seven and between the Mag 7 and the S&P 493 is really quite natural. And why is that? Just look at the EPS growth rates, right? In 2024, the Magnificent Seven collectively are going to grow earnings roughly 40%. And the rest of the market, the 493, are going to grow earnings in the low single digits. Next year, though, we're going to see a convergence of those earnings estimates. Magnificent Seven are probably going to come down from 40% to high teens, and those S&P 493 are going to come from low single digits up to maybe low double digits, maybe 11, 12%. So it makes sense what the market's doing. But if you look at the Magnificent Seven over the long term, they've historically grown earnings at a 50 to 100% faster rate than the rest of the market. And I expect that to continue over the medium term, given how well most of them are positioned for AI. But today, they only trade at a 50% premium to the rest of the market. So if you look at them on a PEG basis, they're actually in line or cheaper. So I think they're okay over the medium term, but this divergence away from them makes sense given the EPS acceleration, deceleration dynamics we're seeing.
Can I ask you, Dom, as this kind of mega AI trend plays out, is it the big companies that are best positioned to leverage and benefit from that, or are there also, small, mid-sized companies in your coverage universe that you know so well that you think also are very well poised to ride that tailwind?
Well, this is the main question. Is AI a sustaining innovation for the large companies and it makes their businesses better, or is it a disruptive innovation, or are we going to see a bunch of new small companies become a lot bigger over the next few years? For the most part, I'm in the camp that AI is a sustaining innovation, and the big get bigger and the big get better because of AI. And why is that? who are the few companies that can actually afford the tens of billions, if not in the future, $100 billion numbers that we're talking in order to build out these large language models? It's really only these companies. And we're funding it with the cash flow of these companies that are the most profitable companies in history. So I expect this build out to continue. And if I look at the AI chip market, I think we have a very clear path from $45 billion last year to $400 billion by 2027. And the only way to afford all those chips is for the big companies to keep doing better.
Well, I guess the question is, will they keep doing better, right? Like, you know, we still, it still doesn't quite answer the question of what are they going to do with all of this? Yes, they're going to keep spending to build out these systems. Yes, it's going to benefit the likes of Nvidia. But at some point, if I'm buying all that compute, I got to make money from it. And so, you know, I think we still don't have the clear line of sight to that, do we, Dom?
We don't have a killer app yet, and if I knew what it was, I'd probably go to join that startup very quickly, right? Because that company is going to be worth $1 trillion. But where will that killer app likely end up showing up? And I think it's likely in voice, right? I don't know if you've played with Google's recent Notebook LM or OpenAI's O1 preview, or what Meta was talking about with Horizon. All of it is surrounding voice. And I think voice is really going to be the game-changing interface. And I think we're going to see some very cool applications come out in the next 6 to 12 months. In the short term, though, you have to remember, all of these companies or businesses are at risk for the very first time in history. We're seeing all of them starting to converge when it comes to competition. And that results in a prisoner's dilemma where they really have no choice but to go spend on those GPUs.
Dom, always great to see you and have you on the show. Thanks for joining us.
Thanks for having me, guys.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
And there's the closing bell on Wall Street. Now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's take a look at where the majors ended the day. We got the Dow closing near the highs of the session here, up about 126, only about a third of 1%. So it was the least best performing major average today. The S&P 500 up close to 1% here, and the Nasdaq really the big winner, up about 1.5% here. Technology definitely leading the way higher. We, in terms of where the focus was today, seemed to pivot away from the rates market and the Fed debate to some extent. Even though we did have some Fed speakers today, they didn't really rock the boat in terms of what they said. We've got Fed minutes coming out tomorrow. We've got CPI on Thursday, but not much to shake the 10-year today. So people pivoting back to those large cap tech names. Jared?
Yeah, let's take a look here at the 10-year, which you were just looking at. I'm going to show a year-to-date chart. In that 4% threshold, it is in play, though, as you note, really not making too much of an impact on the markets today. Higher yields sometimes spell trouble for risk markets. That is the opposite of what we saw today. But I am watching that along with the sector action, which is favoring the mega caps. We have consumer discretionary. That's right here, XLY up almost 1% along with the S&P 500. And then XLK, which is tech, and we got some big names doing some interesting stuff here. Chip stocks are on the rise. Let's take a look at Nvidia, which is now closed within 2% of its record high, and it looks like it right there based on this line chart right here. On an intraday basis, it was a bit higher, but it is right there, and it has now broken this downward trend line, so it looks like it wants to be claiming record highs, but we'll have to wait for that moment to come. And then you look across, Apple's doing well, Alphabet, Amazon, Meta, Microsoft, all in the green, for the most part over 1%. And let's check out the software side, because that has lagged sometimes when chip stocks are surging, but here we see SAP up almost 4%, PanW, Palo Alto up almost 5 or up over 5, and DocuSign up almost 7. And speaking of disruption, let's take a look at the ARK Innovation ETF holdings. We got Robinhood up 10%, Tesla up 1.5%, but we do have a mixed bag here. So it wasn't all risked on, but it did favor a lot of those bigger technology names. Josh.
Thank you, Jared. Markets climbing higher into the closing bell with the S&P back near all-time highs here. We're at a moment where the Fed is cutting interest rates heading into earnings season, and we could see profit growth accelerating. Our next guest says that's going to add fuel to the market's fire. Joining us now is Richard Bernstein Advisors CEO. Rich, great to have you on the show. Let's start right there, Rich. You say cutting rates now in this environment could be putting fuel on the fire. Walk us through what you mean by that, Rich.
Right. So, Josh, good afternoon. Hope you're well. I think that people don't understand how rare it is for the Fed to actually be cutting rates as profits accelerate. Normally, the Fed would be hiking rates as profits accelerate, because profits drive employment, profits drive CapEx, right? You have cash flow, you spend it. And normally the Fed would be cutting rates when profits are decelerating. Well, now we have profits accelerating. We have the Fed cutting rates into that. That is, like, as I said, adding fuel to the fire. I think this is really, really good for cyclical stocks. I don't think it gets much better.
At the same time, they are cutting while we're seeing that the profit accelerating. I was also intrigued by a chart that our Josh Schaefer actually flagged today from Rick Reeder over at BlackRock, looking at where we are in employment now versus where we tend to be during a recession. The bottom axis here measures sort of the bottom there is where you've got the trough of unemployment before you go into recession, which is the vertical line on the right. And the purple line's where we are right now. The blue line's where we are median at this point away from that trough. In other words, to sum it up, the labor market looks good here as well. So it sounds like you think that this is all good news for cyclical stocks, but what are the sort of risks of the Fed cutting into this kind of environment?
Right. Well, Julie, you have to remember that the Fed's main indicators are lagging indicators. They tend to look at the unemployment rate and they tend to look at inflation. Both of those are lagging indicators. The leading indicators weakened. We saw the economy slow down. The lagging indicators then slowed down. The Fed then decided it was time to cut rates. What's the risk? The risk is the leading indicators are starting to head up. right? You mentioned employment. What's a leading indicator of employment? Weekly initial jobless claims. As we all know, they've been very, very strong for about the past 4 to 6 weeks, which argues the employment situation is probably going to get stronger, not weaker. In other words, the number we saw last week that surprised everybody is probably not an outlier, and we're going to see a continuation of these strong employment reports. I think what's a real chance, I don't want to overplay my hand here, but a real chance is that in 3 or 6 months, people are saying that the Fed cut too quickly and that the economy is too strong, and maybe they have to reverse course.
Another trend, Rich, heading into this earnings season, front and center, is going to be AI. There's going to be all kinds of stories written at the end of it, how many times CEOs mentioned AI versus last quarter. I'm interested, Rich, when you talk to your clients, talking about AI, you say, good economic story, disappointing investment story. Why is that?
Okay, so I think individual investors have a very tough time separating that out. Let's talk about the economic story first. Is AI going to change the economy? Of course it will. Why would anybody argue otherwise? But let's understand every major technology changes the economy, right? The internet changed the economy. The automobile changed the economy. My personal favorite, the light bulb changed the economy. Massive productivity enhancer. It turned the economy into a 24-hour economy, right? You can't have a graveyard shift in the dark. So this is not the first time we are seeing technological innovation. In fact, if you go back and read about the 1870s and 1880s, one could argue it was greater than anything we've seen in the last 20 years. So what we have to do is we have to think about not the economic story, but the investment story. And at RBA, my firm, what we try to do is we want to be the one banker in a town with 1,000 borrowers. Think about that situation. You're the one banker, 1,000 borrowers, you're going to mint it. Right? It's almost like loan sharking. You're gonna set the interest rate on every single loan. Turn it around. 1,000 banks, one borrower. That borrower is going to make out like a bandit, essentially getting free money. What the moral of the story here is, long-term returns, investment returns, are always a function of the supply and demand of capital. Well, it's hard to argue right now that AI investments are starved for capital, that AI companies are starved for capital. As you just pointed out, CEOs are going to talk about AI because they know that that's going to generate interest. They know that's going to get them a higher valuation, a cheaper cost of capital. That's not what you want to see as an investor for a longer-term story. Look, AI might work in the next week, the next 2 weeks, the next month. I don't know that. But I can tell you longer term, we do think this is going to be a very disappointing story.
I want to zoom out a little bit here because we're coming up on 2 years of this bull market, and we're trying to figure out, as we always do, whether it's going to keep going. Do you think it's going to keep going? And if so, what is going to lead the next leg of it higher? Or if it's not, what's going to take it down?
So, Julie, we've described the market as a seesaw, if you will, that the market, the way people like to talk about, is probably the fulcrum of that seesaw. And on one side of the seesaw, we've had what you've been talking about, the Magnificent Seven. And on the other side of the seesaw, we have almost everything else in the global equity market. So when people talk about, is the market going to go up? I'm not so sure it is. And our multi-asset products aren't based on just the market going up right now because of that seesaw effect and the fulcrum. Rather, I think the excitement over the next 6 months, year, 2 years is going to be which side of the seesaw are you on and the rebalancing of that seesaw. We saw that, by the way, after the tech bubble, where you saw that seesaw rebalance, and it led to the other side of the seesaw outperforming for a decade. So I think that could be something that we're actually looking at here.
Rich, thank you so much. Appreciate it.
Great to be with you. Thanks.
The third quarter earnings reporting period is going to kick off in earnest when some of the nation's largest banks report quarterly results on Friday. But even if those results are good, the market may not reflect it. Joining us now with more, Yahoo Finance's Josh Schaefer. So we always play this game going into earnings season. What are the expectations? How are we going to react? And it seems like
whatever I say probably won't happen, right? So we'll just caveat it with that. We're going to try, and then something crazy will happen that we're not expecting, right? That's the fun of this. But here is what we are expecting, or what consensus is expecting, right? So Wall Street's expecting earnings growth of 4.7% for the third quarter. That would be the fifth straight quarter of growth. Notably, though, that would be the slowest year-over-year growth since the third quarter of 2023. Julie, I know, as you like to always note, Normally these things get revised up, right? We're talking about 4.7. There's a pretty good chance it comes in higher. That's kind of what history tells us here. But to your point off the top there of why Wall Street isn't necessarily overly excited about this quarter, there's really a lot of factors here. One, the market's basically at an all-time high, right? The S&P 500 almost just closed at an all-time high. You still had people saying, high valuations, is earnings really going to be the story that's going to push buyers back in? We saw that with maybe Nvidia last quarter, right? The earnings were quite good, didn't really help the stock. Maybe that's a story that continues. And then also, we're in October of an election year. And a lot of strategists in their earnings previews over the last week have simply been highlighting this is not normally a great month for stocks. So if you're going to have the bulk of reporting over the next 4 or 5 weeks, investor attention might simply just be elsewhere.
They said that about September too, and September turned out fine.
It did turn out fine, and that's a good point, right? This has been an abnormal election year for the market, right? I think that's important to note. It's been one of the best years for the market that we've seen in an election year ever. So maybe this isn't the October where we get the drawdown, but Julian Emanuel pointed out in his note, the last 4 election cycles, October's been lower. That's regardless of what earnings did, right? Even if companies have been out talking positively, sometimes we forget about the fundamentals and the macro dominates the headlines. That's something that our friend Brian Belsky likes to come on and talk about from BMO a lot. He says, you know, eventually when people come back to the fundamentals, maybe that's when you get a rally off earnings. But if right now we're focused on the macro, we're focused on the Fed, we're focused on interest rates, maybe people aren't tuned into what's actually happening with earnings here. And it feels like right now we're in a setup where there are a lot of headlines. I didn't even mention Middle East tensions, right? But we've been talking about that every day as well. There's just a lot of other things at play. So it will be interesting to see how the market digests this quarter and then also what companies say about the easing cycle. It felt like a few weeks ago, okay, we can all get on the call and talk about rates are coming lower, rates are definitely coming lower. Well, are they coming lower, and how much are they coming lower, and how do companies plan for that? That's one of the key questions that strategists.
Well, and that first crop of companies we're going to get are the banks, so it's particularly going to be pertinent for them. Should be interesting to see what they say. Thanks, Josh. Appreciate it. Coming up, we're joined by the CEO of Elf Beauty to discuss the company's Change the Board Game initiative and long-term commitment to increasing diverse representation. Stick around. You don't want to miss it.
Vice President Kamala Harris rolling out more details of her care economy plan. Yahoo Finance Washington correspondent Ben Werschel is here with the details. Ben.
Hey, Josh, good to see you. So this care economy aspect of what Kamala Harris has laid out has been it's been a slow burn a little bit, a kind of a gradual rollout. And the latest plank today is about seniors. It's a proposal to establish expanded home care for seniors, basically through Medicare. Right now, Medicare doesn't do a lot for you if you're trying to get home aids to help at home, and this would expand it to, according to campaign documents, all seniors. So it's a pretty ambitious program, and it's part of a rollout she's had of kind of this care economy, the child tax credit, making sure families don't pay more than 7% for their things, and then this one today, which is, I think, sort of setting her up for a big part of this being a big part of her message in the home stretch. As she's been doing this media blitz this week, she unveiled it on The View to a approving audience that I think you'll hear a lot more about in the weeks ahead.
And Ben, as you said, this is a big, ambitious plan. Is this one of those that she can just do if she wins the presidency? Right. So what would be the process? How would it get paid for? How realistic is it really?
Right. So a big thing to remember on this is an idea that's been bouncing around. It was in the negotiations of the Biden-Harris Build Back Better agenda. It eventually was pulled out and did make it into the final bill. So this has been a priority for so long. I mean, the one caveat there is, we don't know what Congress is going to be like next year. There is a lot of bipartisan inklings of support for some of these care economy aspects of it. Home care for seniors is something that's in the GOP platform as well, which is notable. The Trump campaign's been noting that today. The child tax credit is something that J.D. Vance has talked about. So it's an uphill climb no matter what, if Harris wins, no matter what she's facing in Congress. But there is areas where you could see something go ahead if they can figure out the cost, which is a whole other aspect. It's very expensive.
Well, and who knows, maybe when a presidential election is not hanging in the balance, they'll be more amenable to working with each other and not scoring points on the board.
Things tend to change a lot after November 5th, for sure.
Yes, we shall see. Thanks a lot, Ben. Appreciate it.
Okay.
Well, it's been an uphill battle for diversity, equity, and inclusion efforts as they face pushback from some activists. Harley-Davidson, for example, John Deere, they're among the public companies that have taken a step back in their commitment to diversity. But Elf Beauty, in collaboration with North Carolina Agricultural and Technical State University, is laying out a brighter DEI outcome. In a new report, the company emphasizing the pivotal role that board diversity plays in corporate success. And here to discuss is Elf Beauty Chairman and CEO Tarang Amin. Tarang, it's great to see you. So this report kind of coming out with some new research, also putting together research already out there about sort of return on equity linked to companies. But before we dig into the results of the report, I want to ask you about your efforts on this. This is not your first effort in this area, and why you guys have still been able to prioritize it. As we said, there's a lot of companies where shareholders are pushing back against this kind of activity.
Well, first of all, thank you for having me. For 20 years, we've been democratizing access to the best of beauty. We make the best of beauty accessible to every eye, lip, and face. We do that for our community. We've been democratizing access to our employees, not only making sure they reflect the communities we serve, but also in giving every employee equity in the company every year to make them real passionate owners. We've also democratized access to our board. Elf Beauty's board is the only public company board out of 4,100 that has 78% women and 44% diverse representation. So diversity is something we strongly believe in, and we believe has a big driver of our success. Now, as good as it is that we're the only public company with 78% women and 44% diverse representation, we don't want to be the only one. So we want to use our platform for positive societal change and encourage other companies to give non-underrepresented populations a chance on their boards. Just given what we've seen and now the data that we've put out today basically shows there's a strong correlation between board diversity and the results of a company delivers.
Well, but Tarang, what do you make of the sort of wider environment where we are seeing pushback against these kinds of efforts that you're describing here? Do you think it has put sort of a chilling effect on corporate efforts in these areas of DEI?
Well, I think for some companies it has, and that's the whole point of our campaign and our effort. It's not episodic. We're deeply committed to this. We published a bunch of stats in terms of what the diversity of corporate boards are. We've shined a light. We've partnered with Billie Jean King. We're here at the NACD, and as part of the NACD, we're sponsoring 20 women and diverse representatives through the NACD Accelerate program to be able to give them the credentials they need and the training they need to be good corporate directors. So I would say, just as there have been pushback in certain areas, it's really important for businesses to stand up, and particularly for us, that's who we're all about. We serve a diverse community. We have a diverse workforce, a diverse board. We want to make sure others join us, and we're happy to partner with others who also see the value of diversity in corporate performance.
And so, Tarang, what's your advice to CEOs who might be listening right now? Should they, for example, have quotas at their companies?
You know, we've never established quotas. The way we developed a diverse board and a gender diverse board as well is really through intention and action. We want to make sure that our company reflects the community we serve. And I think that would be the first question I'd ask other CEOs. How are you reflecting who you're trying to serve? Because if you could do that, there's great benefit all around. We've seen that in our ability to move fast, our ability to now deliver 22 consecutive quarters of net sales growth, averaging over 20% net sales growth. We're the only beauty company out of 1,900 that have grown market share 22 consecutive quarters. So I think our results speak for themselves. And what I'd really encourage other people to do is if they believe in the power of diversity, join us.
Tarang, it's interesting too because you talk about higher return on equity. That was one of the findings of this report: 15% higher return on equity for companies that have above average diversity, reduction in earnings risk, et cetera. Why do you think these things contribute to this? And what was the finding, I should say? I mean, you guys, as you said, you've been practicing it. What was the finding in the report that surprised you the most?
Well, I think it confirmed a lot of what we believed. And I think the real power of diversity on a board is you get different perspectives, different backgrounds, different voices that can help aid a management team be able to see things that we might be missing. And we very much found that true with Elf Beauty Board. We have such a diverse set of experiences. When one board member says something, you might take note. When you have 3 or 4 in a diverse board that get on a particular theme, it really makes you pay attention and see if you are indeed missing something or if you should go in a different direction. So I think there's power, I'd say, well beyond the numbers, which are the specific behaviors that help a company succeed.
Tarang, I'm just curious, as you conducted that research, did you all hold other variables constant, like age, education, experience, so you were able to isolate and say, yes, definitively, it's diversity, as you define that term, driving those returns?
Well, I think the beauty of the study, or the not-so-white paper, is it pulls from a lot of different data sources. And there's a number of different methodologies on those different data sources, but the conclusion is very simple. And it's what we've found in our own performance is diverse teams, diverse boards lead to better actions. And that's really what we're here to help encourage other companies to pursue.
Tarang, finally, while we have you, I want to ask you how business is going, right? Because you guys had been on a tear this year, even though, as you said, your sales have been growing for 22 consecutive quarters. The stock has been waning this year. There have been some concerns I've seen some analyst commentary on channel checks and whatnot. So what can you tell us about how things are going?
Well, what I can tell you is our last earnings report almost a quarter ago, we had 50% net sales growth. We grew over 200 basis points of market share with 2 of the fastest growing brands in skincare. So we're quite bullish on our business. Now, I can't talk about the current quarter because we're reporting in a couple of weeks. But we continue to see 3 areas of significant white space in our business that we're pursuing. We're now not only the #1 unit share brand in all of color cosmetics, but the #2 dollar share brand. We're quite confident over time we can be the #1 brand in color cosmetics. As I said, we have 2 of the fastest growing brands in skincare and Elf Skin and Naturium. And international, we're very much in the early days of continuing to expand our brand international, and we're really pleased with what we're seeing. There's pent-up consumer demand in countries well before we get to them, given our strength in social media and given our accessibility, that incredible value proposition and innovation that we're able to deliver. So I feel really great about our business, and you'll learn more in a few weeks.
Looking forward to it.
Tarang, thanks so much for joining us as always. Appreciate it.
Thank you so much.
Time now to watch Wednesday, October 9th. Starting off on the Fed, minutes from the Fed's September FOMC meeting will be out at 2 p.m. Eastern. giving us more insight into how the Fed came to its decision to cut rates by 50 basis points.
And sticking with the Fed, we'll be getting a big batch of Fed commentary from several Fed presidents, including Raphael Bostic, Susan Collins, and Austin Goolsbee. Goolsbee will be talking to Yahoo Finance's Jennifer Schonberger. He talked to her, I should say, last week about the September jobs report, praising the report and suggesting it's a good sign toward getting to the Fed's 2% inflation target.
And moving over to housing, weekly mortgage application data is coming out in the morning from the Mortgage Bankers Association. Last week, mortgage rates decreased by 1.3% after several weeks of increasing. We're going to get more insight tomorrow on how lower interest rates could impact application demand.
And finally, Hurricane Milton expected to make landfall in Florida as soon as tomorrow. According to the National Weather Service, if Milton stays on course, it will be the most powerful hurricane to hit Tampa Bay in over 100 years. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Stocks staging a late session rally, and the S&P 500 is back near all-time all-time highs. We're taking a deeper dive into the market action. Plus, as Hurricane Milton churns toward the Gulf Coast and millions of Americans are still recovering from Hurricane Helene, Zillow is offering a new product to help prospective home buyers calculate their climate risk when buying a home. How it works, that's straight ahead. And the return to office trend finally making a dent in the commercial real estate sector, the availability rate declining for the first time in 5 years. A closer look at that trend coming right up. First Street and Zillow are teaming up to create a first-of-its-kind rating system to assess climate risks on for-sale properties. Now, the monitored risks include heat, wind, and flooding, the latter of which becoming particularly relevant with Hurricane Helene hammering the southern U.S. and Hurricane Milton expected to make landfall in Florida in the next couple of days. How is this all impacting the broader real estate market? Well, joining us now is Jeremy Porter, head of climate implications at First Street. Jeremy, it's good to see you. So Hurricane Milton is looming here. When you have this kind of impending hurricane, Jeremy, I'm just curious, how do you all get to work and start trying to figure out, map out possible impacts here?
Yeah, we end up working backwards towards a lot of the different scenarios that we have in regard to the potential impact of exposure to climate risk. So when we build our flood models, we're building everything from a tidal flood model, a 1-year event, all the way up to a 500-year event. So one of the things we have to do is we have to look at the data. What do we know about the actual hurricane? What's the return period attached to it? Is it a 100-year storm? Is this a 500-year storm? Is it something more frequent? And then from there, we can start to attach losses and expectations around how it might impact the community.
And Jeremy, we keep hearing about how these storms are intensifying, right? Milton in particular is supposed to be a very unusually strong storm. How quickly, since you started doing this, have you had to have been updating your models to adapt to the changing conditions that you're seeing out there?
Yeah, it's a really good point. I mean, Milton, for instance, was, a collection of clouds like a week ago, and it exploded into a Category 5 in almost no time. And it is indicative of what we're seeing more and more often now. We're seeing the warmer sea surface temperatures, the warmer atmospheric temperatures are driving stronger hurricanes, stronger storms. And when you have these stronger storms, they're causing more damage in places like potentially Tampa. With Milton, we have seen, as we built our models out, updates that come from the global climate models and other sources of data that we feed into our models. And as those come in, we're updating our models. But you're right, they're relatively predictable at this point. We can understand at least out into the near future what the climate is likely to look like and how that might impact the development of these types of storms. But the trend is negative. We're seeing potentially more storms, and if not more storms, stronger storms when they do occur.
And Jeremy, as we mentioned, you launched this suite of climate risk data for Zillow. Explain how that works and why you launched it now.
Yeah, our mission has always been to quantify and communicate climate risk. And when we first started about 8 years ago, there were really very few resources that people had for understanding what their climate risk looked like. And the resources that did exist were things like FEMA zones. And FEMA zones are just not that user-friendly. They don't capture all of the sources of flood risk. So, what we ended up doing was creating our own hazard models at the property level so people could understand not only what the risk is today, but what the risk is into the future, what the risk is to their specific property, and how that might impact their pocketbooks. And that by connecting all of those different dots together, we found a way in which people responded. People, wanted to understand this information. So the connection to Zillow and other real estate platforms is really just a natural way for us to roll our data out and get it into a place where it can be really impactful. As people are buying homes, this is the kind of information they need to make smart decisions.
Well, and we're seeing it already affect some people's decisions in terms of where, entire swaths of the country that have become less attractive over time. In your research, what are you seeing as some of the places that some cities, for example, that people are avoiding because they're concerned about climate risk, and conversely, areas that maybe they're gravitating toward?
Yeah, it's a really interesting question because a lot of what we've seen up to this point has really been within city movement, people avoiding kind of low ground in Miami and opting for high ground in Miami. A lot of people want to be in the same community. They want to be close to family. They want to keep the same jobs. But, if they're given information about climate risk, they'll use that just like they use education and school scores, and just like they use walkability scores, and that'll factor into their home buying information. We actually did an analysis where we saw that people that were exposed to this kind of information systematically searched for lower risk properties versus individuals that weren't exposed to this information. And to your second point, we're not seeing huge macro scale movement at this point where people are sort of fleeing the South and going to places up north that maybe have less hurricane risk. We're really seeing a lot of this movement within cities, and flood and wildfire smoke tend to be the primary drivers that people are responding to.
I'm curious, Jeremy, do you see in your data any differences between homeowners and renters in terms of how they respond and react to the kind of climate data you're able to offer?
Yeah, homeowners for sure are much more interested. They're thinking about an investment in a property that they're going to hold on to for 20, 15, 30 years. Renters are interested. Renters tend to be much more interested in the community stats. They want to understand how climate might impact the critical infrastructure, the electrical grid, the road network, things like that. Property owners want to know that information, but they also really want to know is climate going to impact my property specifically? How much is that going to cost, and how should I protect myself against that risk?
Jeremy, great to have you on the show today. Thank you so much for your time. Appreciate it.
Thanks for having me.
U.S. stocks closed higher as investors welcomed a rebound in tech and Yahoo Finance's Jared Blickery joins us now with more on the trading day takeaways. Jared.
Well, thank you, Josh. We are getting some mixed signals when it comes to risk, and that is my first point. The S&P 500 closed within a hair. It was 1.98% of a record closing high. And I just want to show you the chart on a year-to-date basis. I've been showing this quite a bit, so I won't dwell on it. But we are right here, and we've basically stayed above the old highs that were potentially acting as resistance before. Now they should be support. So as long as we are right here above 5,700, this risk rally is still in play. But we are getting some pushback here. And we can look at the bond market, for instance. Here's a 10-year T-note yield, and we can see that is now above 4% again. Rising bond yields, sometimes they tend to act negatively on risk prices. And I want to show you this Ed Yardeni chart as well. And this is kind of one of the main points here. This is showing the 2's10 spread. So this is a 10-year minus a 2-year. And guess what? It was just negative for a long period of time. It was almost a record, and it might have been a record. And then it turned positive, and now it's hovering around that zero level. So it makes me think maybe we're not out of the woods yet.
And so is that my big takeaway as an investor, the messages the bond market's sending me?
Yeah, and let me show you one more thing, because I think this is critical too. This is the bond market's volatility index. We talk about the VIX with respect to equities, and for bonds, we have the MOVE index. This is the ICE B of A MOVE index. This is the highest point we've seen since early January. You'd have to go back to the beginning of the year to see that. I'll show you a 5-year chart so you can see what happened over the pandemic. We got a very higher high here, but we were kind of on the decline. Now it looks like we're approaching a rounded bottom. So when we see this, when we've seen this in the past, the MOVE index screaming higher, well, that has caused problems for equities. We're just not seeing it just yet.
All right, Blickery point number 2.
All right, no landing, guess what? The risk is reignited, and that's my main point right here. So last Friday, the non-farm payroll report, that was out of sight, 250-something thousand jobs, but the wage inflation implied therein kind of changed the game. People were worried about the hard landing before, and now we're starting to see some inklings of a no landing scenario. I was just talking to a guest on Stocks in Translation, Kevin Mon, and he said that risk, no landing, is back on the table.
And buybacks, wasn't that in focus for you today as well?
Yeah, very much so. Let's get to that because
look at that chart.
Yeah, I know. This is a blackout period. This goes from August, about mid-August, and now because we are heading into earnings seasons, corporations will not issue buybacks, will not do buybacks because it conflicts with their issuing their reports. So this buyback, that lasts through basically the end of October. It's going to start tapering off pretty soon, but we're still going to have a lot of action there. Beginning of November, it kind of starts fading away.
That's when you would expect a resumption.
Yeah, and let me show you this. I've shown you this many times. This is the first 10 days and the last 10 days of the month. September was not negative, so it didn't do this. Maybe this is happening in October. We're seeing a little bit of a rebound, but check out the second half of October, not expecting much. Things traditionally reaccelerate in November. That coincides with the election. And I'm just going to show you this VIX seasonality one more time. That is potential for a VIX spike, which means lower equities into mid-October, which is facing us right now.
All right, final Blick report.
I got some good news because the AI trade is back, and I got to show you what's happening with Nvidia, which itself is just closed very close to a record high. I'm going to show you our semiconductors heat map here. And this is a performance of the semiconductors over the last month. Nvidia up 29%. That is significant. And I'll show you the year-to-date chart. This stock has been acting very well technically. And I'll put some candlesticks on so we can see the highs and lows. Basically, we had a record high here, and then that previous high acted as support, and it has contained all this price action. So Nvidia has been going sideways for quite a while, but now you can see it is approaching the other end. If it leaps above, according to history, guess what? Every time it's done that, it has gone on to much higher highs, but it could also fall back down to support. It could go right back down to 100.
Is that the one name on the Jared Blicker radar, one AI name?
Yeah,
name?
It gets better because guess what? Bitcoin, things are looking up for Bitcoin. I'm not going to show you the Bitcoin price right now. I want to show you MicroStrategy.
Oh, yeah.
And let me get the intraday prices here. I'm looking for MSTR. There we go, up 3.28%. And here's a year-to-date chart. By the way, I got this idea from Steve Straza over at All Star Charts. It is right here at the Rubicon. And what I'll tell you is MicroStrategy tends to lead Bitcoin. Bitcoin relatively is still down here, but if it follows through, MicroStrategy could be leading the way towards more record highs in Bitcoin, but I don't want to get too ahead of myself.
All right, somewhere Michael Saylor is smiling.
I hope so.
He's off. Well, he should be smiling.
Yeah,
I'd be smiling too.
Come on the show and smile at us.
Absolutely. Well, everyone has a money story that we're not proud of course. Yahoo Finance Podcast, Living Not So Fabulously, dives into these tales, helping you to become more grounded with your money by learning from others' journeys. Without shame, without judgment, join husbands and hosts David and John Ottenshire every Wednesday at 12 p.m. Eastern. Stick around, much more Asking for a Trend still to come. The U.S. office market reached an important milestone in the third quarter. The overall availability rate peaked and is declining for the first time in more than 5 years. This comes as companies like Amazon have pushed for employees to return to the office 5 days a week, sending office attendance rates to a post-pandemic record in July. And joining us now with more is John Gates, JLL, CEO of America's Markets. John, it's always good to see you. I have a friend, John, who works at Amazon. Believe me, he was texting me. He got that message. He was not happy, but you know what? Welcome to the party. John, let me ask you this.
The rest of us were excited, Josh. The rest of us were excited.
I can imagine. So, John, let's start high level. The American office market, John, as it stands right now versus, let's say, a year ago, 12 months ago, John, the same, better, worse? How do you characterize it?
I would say it's been slowly recovering for some time now, maybe even 18 months. We saw an acceleration, though, in the third quarter, and some of the statistics start to look pretty good. Total leasing volumes in Q2 and Q3 were about 86% of pre-pandemic levels, which is the highest that it's been.
And the Fed, John, we know, did deliver that supersized cut, surprised some. How does that ripple through the sector?
It affects the capital market side of our business pretty meaningfully. Commercial real estate, as you know, is a highly leveraged asset typically. And so declining cost of debt capital would be a very good thing. The futures markets would imply, interest rates will continue to come down, but perhaps a little slower than we thought even a month ago, just given the jobs report recently. But it's good news by and large because of the way you capitalize commercial assets.
And John, let me ask you, as you look across the country in terms of, relative strength, regionally, what would you call out, John?
New York, for sure. Boy, New York has been very active this year, which is great to see. And there's a real pace to the city and our industry again. And then I would say after that, largely the larger markets across the Sun Belt are still quite active. So we're doing fairly well here in Dallas, Nashville, Phoenix, Atlanta, the Carolinas. The Florida markets are still solid, notwithstanding what's happening down there recently.
I am interested there, John, because you mentioned Florida, Carolinas. I mean, how do these hurricanes, first Helene, now Milton, how does that potentially impact what you're seeing out there?
To the extent they become, long-term phenomena, it could be a concern for some corporates in locating jobs. Typically, though, anymore, the jobs follow people. So if populations start to decline, then jobs will decline there. If people are still moving there, then I still think you would see jobs going there. And certainly we do in South Florida right now.
And you mentioned these areas where you see relative strength. I am curious, John, just conversely, what would you call out as, relatively weaker regionally?
The Pacific Northwest is still a little slow because large tech is not adding positions yet, other than in the artificial intelligence space, which you guys report on quite thoroughly. So there's been job growth there and therefore net absorption, but broadly tech is not, and so that's one of the slower areas. The Midwest has been slower, although we've seen a bounce back in Metro Chicago is obviously the biggest market. And then certain submarkets, some of the CBDs, downtown LA, would still be fairly slow, but the West Side is not.
When tenants are shopping around, John, I'm curious, what are they shopping around for? Are there trends there?
Yeah, there's very clear trends. We call the headline flight to quality, which maybe is a euphemism for newer and nicer and more amenities and other cool things you can do in an office building, gyms with classes in yoga and other things like that, great places to eat, rooftop decks are a big deal. And then location matters a lot too. If we learn anything in the pandemic is people don't like the long commutes. And so my example in LA is a good one. Even at our own firm, we've had an awful lot of our people used to go downtown every day, want to move to our office on the West Side in Century City, and that would be, not uncommon.
And so in terms of the kinds of buildings people want, John, where the appetite is, are you actually seeing, any kind of supply constraints there?
You're starting to on the top end because that's where leasing has been concentrated. So newer office buildings, perhaps mixed-use buildings, highly amenitized, and a lot of entertainment options there as well. We've had a very low construction start environment, so there's only about 40 million square feet of office space under construction in the United States, and only about 30 million square feet of starts this year. In addition to that, we see space becoming something different than office space. So conversions to multifamily or perhaps hospitality, or in some cases even torn down, although that's not very common. And so the combination of those two things means the actual amount of office space in the United States is probably contracting slightly for the first time in a long, long time.
John, always great to have you on the show. Thank you for joining us.
Thank you for having me.
And coming up, we're taking a look at the state of the labor market with our chart of the day. Stick around, we're asking for a trend on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, 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 it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
For today's chart of the day, we're looking at unemployment trends amid a recession. Yahoo Finance's Julie Hyman joins me now with a closer look.
And this chart coming to us via Rick Reeder, the CIO over at BlackRock here. And what it looks at is what we tend to see with unemployment trends during recession and what we are seeing this time around. So what you have here is the months from the recession, before the recession, then to the recession. This is the recession. This line And this is the median unemployment rate. So let me explain this here. So what we're seeing is that unemployment rate tends to trough about 12 months or so before the start of a recession. Historically, this is what we've seen. Now you have to look at where we are now with the unemployment rate. And it's much lower than it typically is when we see the start of the recession. This is evidence in readers' mind, yet more evidence that indeed we are not entering a recession here, that this is an unusual cycle where you have had, yes, a troughing of the unemployment rate, but it hasn't come up enough to signal a recession. And he says Friday's jobs report was yet more evidence that that is indeed the case. He said the unemployment rate has decreased for the second consecutive time. That is far from what you see in a typical recession. And he says that Friday report reaffirms our view that the U.S. economy remains resilient. What does all of this mean for the Federal Reserve? He says the Fed should and will continue to move the policy rate lower, but he says that is the process of measured rate normalization rather than a dramatic reaction to a more recessionary environment. And this has really been the crux of a lot of our discussions this week in the wake of that stronger than expected jobs report on Friday. Does the Fed keep cutting to forestall more weakness here, or does it pause with its cutting because of concerns over reignition of inflation? Or the third choice, which readers seem to be indicating, do they continue cutting not because they're concerned about the labor market, but rather to bring rates back to a more normal level? We shall see, Josh.
We shall, Julie. Thank you. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.